Good afternoon, investors. You're now on KleverStock with me, Wanizul, and I'll be serving you the midday roundup with the latest market updates from this morning up until now. Kicking it off with Bursa Malaysia. Malaysia's primary stock index remained largely range-bound on Friday morning as investors grappled with fresh anxieties over rising crude oil prices and a deteriorating geopolitical outlook in the Middle East. Now, the FBM KLCI slipped a marginal 0.6 points to 1,711.99 at the start of trading, a performance that Apex Research described as a mild decline when weighed against deeply negative overnight movements on Wall Street. Geopolitical risk took center stage following reports that Iran warned Washington would bitterly regret the sinking of an Iranian warship off Sri Lanka, effectively extinguishing earlier hopes for swift de-escalation. Now, Apex Research noted in its report that markets are likely to remain cautious in the near term, stating volatility may stay elevated as participants assess the potential implications for global energy supply and inflation. Nevertheless, any signs of diplomatic de-escalation could help stabilize sentiment and support a gradual recovery in risk assets. Now, the energy sector emerged as a primary beneficiary of the supply concerns. Petronas-related stocks saw sustained interest, with Petronas Chemicals rising 33 cents to 3 ringgit 84 cents and Petronas Dagangan gaining 46 cents to 22 ringgit 66 cents. However, the aviation sector bore the brunt of the conflict's expansion. AirAsia X was the day's most active counter as its shares dived 9 cents to 1 ringgit 33 cents. Analysts pointed to the mass closure of global air routes and costly necessity of rerouting flights as the primary drivers behind the sell-down. On the domestic policy front, Malacca Securities Research highlighted that Bank Negara Malaysia's decision to maintain interest rates provided a degree of stability for the financial sector. Now, the firm stated that the decision to keep rates steady should be positive for the banking sector, underpinned by favorable US-MY rate differentials and a stronger ringgit, which should benefit banks' assets. Now, the further also noted that robust prospective dividend yields from these banks could serve as a hedge against the current wave of market volatility. Heavyweights banks saw mixed performance despite the policy support, with Maybank edging up 2 cents while CIMB and Hong Leong Bank dropped 7 cents and 4 cents respectively. Now, as the conflict enters its 6th day, market participants remain in a wait-and-see mode, balancing the benefits of a stronger ringgit against the inflationary pressures of a potential long-term spike in energy costs. We move on to our local currency and foreign exchange. The ringgit opened nearly flat against the US dollar this morning, trading in a narrow range as foreign exchange markets continue to weigh the impact of a deepening Middle East crisis. Now, at 8 a.m. this morning, the local currency was quoted at 3.9430 or 3.9550 against the US dollar, compared with Thursday's close of 3.9415 or 3.9480. Bank Muamalat Malaysia Berhad Chief Economist Dr. Muhammad Abzanizam Abdul Rashid noted that risk of sentiment continued to dominate the market as global oil prices remain elevated and major indices trade in the red. Now, a key pillar of support for the ringgit has been Bank Negara Malaysia's decision to maintain the overnight policy rate, the OPR, yesterday at 2.75%. Now, the move was widely expected by economists and signals that policymakers are choosing to monitor the duration and severity of the Middle East conflict before adjusting the current monetary stance. Abzanizam added that policymakers appear to be monitoring developments in the Middle East before making any changes to the current monetary policy stance, and as a result, the ringgit is expected to remain range-bound today. Addressing the recent spike in global crude prices, with Brent crude now trading at $85 41 cents per barrel, analysts suggest Malaysia is increasingly insulated from energy price shocks. Malaysia's structural reforms have significantly reduced the national budget's dependency on petroleum, with oil projected to contribute only 12.5% of total revenue in 2026. Now, this dynamic, combined with the export of higher grade crude at a premium, helps anchor the local currency even as 10-year US even as 10-year US Treasury yields climb to 4.13%. Now, at the opening bell, the ringgit exhibited a mixed performance against major global and regional peers. The local note strengthened against the euro to 4.5762 and improved vis-a-vis the Japanese yen to 2.5024. However, our ringgit did weaken slightly against the British pound to 5.2659. Within ASEAN, the ringgit appreciated against the Thai baht to 12.4072 and the Singapore dollar as well to 3.0795, while remaining largely unchanged against the Indonesian rupiah and the Philippine peso. Now, traders, you guys are expected to maintain a cautious stance for the remainder of the session as the geopolitical situation evolves. Now for some local economic news. The Malaysia External Trade Development Corporation, Medtrade, has launched a proactive mitigation framework to shield Malaysian exporters from the fallout of the escalating military conflict in the Middle East. Now, following the February 28th military escalations involving Iran, Israel, and United States, the agency is taking decisive action to address maritime blockades, surging freight charges, and also critical supply chain disruptions. According to a specialized survey issued by Medtrade, the impact on the local industry is significant. Of the respondents, which include 53.7% MSMEs, 32.7% mid-tier companies, and 13.6% multinational corporations, a total of 63.9% of companies expect the ongoing conflict to affect their operations. Now, these businesses cited shipment delays, rising ocean freight, and insurance costs as primary concerns. Furthermore, firms anticipate order cancellations and a sharp increase in raw material prices, particularly plastic-based materials linked to crude oil. Now, to navigate the current maritime disruptions, Medtrade is advising supporters to move away from high-risk traditional routes. Now, the agency is encouraging the rerouting of shipments to more stable entry points in the region, such as the port of Fujairah in the United Arab Emirates and the port of Salalah in Oman, as well as the use of land transportation where feasible. Now, Medtrade Chairman Datuk Seri Rizal American, he said that we are enabling Malaysian exporters to redirect trade flows into geographically proximate and economically stable markets. He also noted that this strategic pivot strengthens Malaysia's position as a regional trade hub. To ensure trade continuity without exposing personnel risks or personnel to high-risk zones, Medtrade has intensified its digital matching initiatives. The agency's virtual e-biz match sessions will replace physical trade missions in affected areas, allowing companies to connect with global buyers remotely. Now, simultaneously, Medtrade is accelerating expansion efforts into less affected markets, including South Asia, Latin America, Africa, and strengthening intra-Asian or ASEAN trade integration. Medtrade CEO Abu Bakar Yusof emphasized that the immediate priority is to mitigate the double-ended blockade affecting Malaysian cargo. By leveraging its local offices in Dubai, Jeddah, and Cairo, The agency aims to resolve real-time logistical hurdles and position Malaysia as a reliable alternative supplier for partners seeking to diversify away from the regional risks. Now, the agency is also collaborating with financial institutions to facilitate access to insurance packages for exporters facing higher war risk premiums on cargo abandonment. Now, we're going to be continuing with corporate news updates. Malaysia Airlines is rolling out additional flight services between Kuala Lumpur and its key European hubs in London and Paris to assist travelers caught in the wake of widespread global network disruptions. Now, from March 6th to 8th, 2026, the national carrier will operate supplementary flights to London Heathrow and Paris Charles de Gaulle airports, providing much needed relief for passengers facing travel uncertainty. Now, these extra services are set to run alongside the airline's existing daily schedule, utilizing its fuel-efficient Airbus A350-900 fleet to manage the surge in demand. Now, the decision comes as part of a proactive strategy to stabilize travel flows between Asia and Europe during a period of significant international instability. Now, in a statement released earlier today, the airline emphasized its role in maintaining vital connections during difficult times. Now, by deploying increased wide-body capacity between Asia, Europe, Malaysia Airlines aims to help reunite families and support onward journeys. That was stated by the company. Now, to ensure the highest level of security, the airline confirmed that these specific services will follow alternative flight paths designed to bypass affected regions. Safety remains the airline's top priority, the statement added. Now, beyond the additional flight frequencies, Malaysia Airlines is coordinating closely with its extensive network of partner airlines across both continents. Now, this collaboration is intended to streamline onward connections for travelers whose original itineraries were impacted by disruptions elsewhere in the global aviation system. Brian Fong, Chief Executive Officer of Airline Business at Malaysia Aviation Group, highlighted the importance of reliability in the current climate. Our priority is to maintain connectivity and provide reliable options for travelers, especially in times of uncertainty, he noted. Now, the airline has committed to a continuous monitoring of global developments and stands prepared to adjust its capacity further if required. This initiative is framed as a reflection of the carrier's broader mission to serve as a reliable link between nations while delivering its hallmark Malaysian hospitality. Now, passengers looking to secure seats on these supplementary flights are encouraged to book via the official Malaysia Airlines website or mobile app, as the carrier remains a trusted bridge for those navigating the current complexities of international travel. We're now going to take a short break, but don't go away. We will return shortly with corporate news developments right after this. And welcome back to the Midday Roundup. Let's continue with corporate news updates. So, Steelhawk Berhad is set to strengthen its financial standing in 2026, and that's driven by a strategic rebalancing of its revenue mix and an aggressive push into the burgeoning data center sector. Now, TA Research has maintained a buy call on the stock with an unchanged target price of 41 cents, citing a robust order book and the company's ability to capture emerging infrastructure opportunities. Now, the research house also noted that the company's expanded engineering, procurement, and construction and commissioning (EPCC) segment served as the primary engine for growth in the past year. But this contribution is expected to normalize as the oil and gas segment regains momentum. Now, TA Research said that throughout 2025, the expanded EPCC segment had contributed significantly to the group, accounting for 77%, which was about 94 million ringgit of total revenue. However, this contribution is projected to decline to around 45 to 55% in 2026 as the oil and gas or ONG activities gain traction. Now, management has shifted its focus back to the ONG sector, where improving industry conditions could translate into significant new business. The group expects potential contract awards of up to 150 million ringgit within 2026 as activity strengthens. Steelhawk's exposure within the sector remains largely concentrated in downstream operations, which account for about 85 to 90% of its involvement, reflecting its strong position in plant maintenance and related services. Now, in the near term, earnings visibility is supported by a sizable backlog within the EPCC segment. As of December 31st, 2025, the expanded EPCC segment's order book stood at 138.1 million ringgit, which is expected to be recognized across 2026 to 2027. Beyond this confirmed backlog, the company is actively pursuing a tender book valued at 120 million ringgit within the ONG sector, covering 6 projects and 2 call-out contracts. Its civil, mechanical and maintenance segment also holds 30 million ringgit worth of shortlisted jobs, while bids for 18 million ringgit in utilities projects from Tenaga Nasional Berhad further bolster the pipeline. Diversification into data center infrastructure has also provided an additional growth avenue for the group. TA Research also noted that the group has secured a mechanical and electrical works contract for a data center project in Johor, valued at approximately 35 million ringgit, with completion expected by July 2026. Now, the research house added that Steelhawk is also bidding for 2 more similar contracts for the full year 2025. Steelhawk's net profit rose to 13.7 million ringgit from 12.7 million ringgit in 2024, as revenue surged to 122.3 million ringgit from 78.4 million ringgit in the preceding year. Up next, we have some business updates. KPJ Healthcare Berhad, Malaysia's largest private healthcare provider, has announced a bold strategic roadmap to increase its total bed capacity by 56% over the next 4 years. By 2030, the group aims to add 2,200 new beds to its current base of 3,934, representing a 9.3% 5-year compounded annual growth rate, or CAGR. Now, according to UOB Kay Hian Research, this expansion will prioritize high occupancy facilities and align with the group's regional hub and spoke model, which is designed to enable more efficient scaling of capacity and better utilization of resources across its network. Now, the 2026-2030 strategic plan marks a structural evolution for KPJ, moving away from a traditional network of hospitals toward a health system focused on clinical excellence, research and education. Now, this transition is centered on 4 key specialties: heart and lung, oncology, neurology, and stroke, as well as orthopedics. The Centers of Excellence, or COEs, will function as the primary hubs for complex and specialized treatments, while simpler daycare procedures are channeled to other hospitals and ambulatory care centers. Supported by artificial intelligence diagnostics and genomics, the group noted that by concentrating on higher acute cases at COEs, the strategy should lift revenue intensity while improving the utilization of existing assets. To support this high acuity focus, the group plans to add 500 new consultants by 2030 to its current base of 1,500 and commission 50 new operating theatres. A significant driver of this growth is medical tourism, which saw 2025 revenue reach 263 million ringgit, marking a 13% year-on-year increase. UOB Kay Hian Research pointed out that the group aims to sustain double-digit growth for 2026 by expanding regional outreach and strengthening market penetration in key neighboring countries. Through targeted marketing and specialized clinical offerings, KPJ is positioning itself to capture rising cross-border patient flows into Malaysia's private healthcare sector. Operationally, the group's newer assets are showing rapid progress, with KPJ Kuala Selangor turning EBITDA positive within just 4 months of commencing operations in August 2025. Meanwhile, Damansara Specialist Hospital 2 is expected to have longer gestation times as it plans to add an additional 75 beds to its existing 127-bed capacity. So UOB Kay Hian Research has maintained a buy call on KPJ with a higher target price of 3 ringgit 40 cents, though it cautioned that potential downside risks include regulatory policy tightening and any inability to pass on operating cost increases to customers. And that is a wrap for the Midday Roundup with me, Wanizul, right here on KleverStock. Thank you so much for listening and tuning in to us. Hope you have a wonderful weekend ahead. Thank goodness it's Friday. We'll see you again shortly for our upcoming live stream programs. Have a good one.